question 2. So question 2 says, Spree Limited was established in year 2011, right? So it's Spree. It was established in the year 2011 and is now South Africa's largest online store with major divisions in electronics, lifestyle, media, gaming, and apparel. Right. Spree Limited is listed on the Johannesburg Stock Exchange. You have been employed as the group consolidations and reporting specialist. Oh my God. You are the specialist in the Spree Group reporting division responsible for providing a technical support to the group and to prepare for consolidated financial statements for the year ended 30 June 2023. Your role reports to the group financial director, Mrs. Julie CASA, a member of the South African Institute of Chartered Accountants. So you report directly to the financial director. Right. Spree Limited holds investments in Zara and in Isabella Property Limited. What I love about this question is they're actually using real names, eh? Because other questions, they will just be creating things we don't know and some names we've never seen. So what I like about this, they're actually using real, you actually know Zara and Isabella, right? It actually makes sense. Okay. Where was I? The Spree Limited holds investment in Zara and Isabella Property Limited. All the companies in the Spree Limited group have a 30 June year end. I think I was saying this yesterday. Because groups can be really, really broad and complicated, they try to cut out some things. So for us in this level, it's always going to be the same financial period, right? When you get to CTA, that's where they may change that. It will show you that we can be the same group and have different financial period and how we can bring them together. But it isn't clear. We are just going to be having the same financial period all the time. Okay. Right. So let's continue. Then it says, here we have the trial balance that is given at 30 June 2023. And here are my figures. Spree. Remember, the first company is always the parent company, right? So we've got Spree Limited, we've got Zara Limited, we've got Isabella, right? Property, plant, and equipment. It's given at carrying amounts, very important. Right. Then we've got investment in Zara, Isabella. All right, those are the only two investments. Then we have trade and other receivables, cash and cash equivalents, inventory, dividends paid, share capital for all three, return earnings at the beginning of the year. Perfect. Profit for the year, deferred tax liability, trade and other payables. So they give us profit for the year. So if I have to do consolidated statement of profit and loss, it means I'm starting here. All right. So I want to jump to the required before we read the scenario. Oh, guys, 1 minute. I'll be with you now. 1 minute. Yo, guys, I'm so sorry. So sorry. I keep checking on the kids are coming back. So sorry about that. Yes, let's continue. Let's continue. Let's continue. Okay, where were we? So we said we're gonna read the required section first before we read the scenario, ne? Okay, A, it says draft an email. Guys, when you're told to draft an email, you need to know the formats. Now, you've seen this a lot. They give you formats of how it is. You can even open your email if you're not so sure of format of the email, right? So it has to be in an email format, right? Then it says, so draft an email to the group financial director. You're writing to the director, Mrs. Somebody there, we saw there, of Spree Limited Group to discuss. You're discussing the correct classification and measurement of the investment in Invest Global Limited bond. So we have not found information on that yet. We're still gonna go look for it to read it. And this must be for the year ended 30 June 2023, according to the requirement of IFRS 9 financial instruments. So here we are focusing on financial instruments. It is 12 marks. Communications mark is 1 mark. Communication. So they are presentation and layout and logical arguments, 2 more marks. Okay, 2 marks for free. All right. So like I said, they usually give this mark unless yours is really looking like off, completely off. So if you have your email properly written, and you've at least done a discussion, then you're gonna get your mark. Okay, but if maybe you decide to give us a calculation or something like that, you will lose this mark. But they usually give it to everybody who has at least answered the question, right? And it should at least look like it's making sense. Then you get your 2 marks. Right, so that was 12 marks. We'll come back to that. We'll hit everything, remember? Then calculate the consolidated profit. This is what I was saying. So we're going to start with the profit for the year that is given. So calculate the consolidated profit for the year attributable to the owners of the parent that will be presented in the consolidated statement of profit and loss and other comprehensive income for the Spree Limited Group for the year ended 30 June 2023. 10 marks. Okay. This is pure calculation, like pure. Then C, it says prepare only the non-current assets and equity section of the consolidated statement of financial position of Spree Limited Group as at 30 June 2023. This is a 23 mark question, so it's a serious question, all right? Serious one. Okay, then D, explain with reason the ethical concerns. Like I usually don't do these ones. Ethical concerns related to the matters arising from the preparation of consolidated financial statements for the year ended 30 June 2023 as outlined in point 10. Usually when they ask you this, it's something might have gone wrong or there's something that they're not respecting. So you have to come down and tell them how this should have been and what is that they're doing wrong and things like that. Okay, so every question is always going to have this. They're trying to boost your marks by giving these kind of questions. All right, so we have basically 3. I'm going to do A, B, and C. D, it's yours. You can do that one at home. That ethical consent story. All right. Then please note your answer must comply with the requirements of IFRS, International Financial Reporting Standards. Accounting policy are not required always. All calculation must be shown and amount must be rounded off to the nearest rand. So every amount round off to the nearest rand, calculations must be shown. All percentages, very important. Calculators should be rounded to the nearest 4 decimal places. So once you see that it's already saying 4 decimal places, you have to go to your financial calculator and set it up to 4 decimal places. Right, so that when you get your answers, when you begin to use it, you get answers in 4 decimal places. Then it says, show all data inputs into your financial calculator where applicable. Notes to the annual financial statements and comparative figures are not required. Ignore VAT and ignore value-added tax and dividend tax. All right. So that is it. And then let's go to our question. The A, we're not going to start with A. A, we are supposed to discuss, right? I want to read A again so we can go and answer A. A says draft an email to the group financial director of Spree Limited Group to discuss the correct classification and measurement of the investment in Invest Global Limited bonds for the year ended 30 June 2023. So it's another discussion, all right? This is on Invest Global Limited Bonds, and this is on IFRS 9 financial instruments. So let's go and read. Okay, there it is, number 8. It's on number 8. Let's go and read. Right, it goes as follows. It says on 1 February 2021, Spree Limited purchased 9,500 bonds. Spree is the parent, yeah. 9,500 bonds from Invest Global Limited with a fair value of 120 rand per bond and incurred 5,000 transaction costs that were directly attributable to the acquisition of the bonds. Right, settled in cash on the same date. The bonds are redeemable. So first of all, what happened? We purchased. Very important. We are the one who purchased. Therefore, it's an asset. If we had issued, it would have been a liability. Okay. Right. So it's a very important point to see or to notice. Right. Where did I stop reading? Okay, and incurred 5,000 transaction costs that were directly attributable to the acquisition of the bonds, settled in cash on the same date. The bonds are redeemable at a par value of 100 rand each on the 30th of January 2027. So it starts in February 23, ends in January 27. And interest is paid annually in arrears. On the 31st January, a coupon rate of 12%, right? On 21st January in arrears at the end of every year annually, we have a coupon rate of 12%. Spree Limited holds the investment in investment global bonds with the objective of collecting future contractual cash flows of principals and interest at a specific date until maturity date. The bonds were not regarded as credit, very important. Let me just yellow. The bonds were not regarded as credit impaired and on initial recognition, and the credit risk has not increased at any stage since purchase. Right. Then the 12 months probability of default was assessed to be 2% and 4% in February 2023. And on February and June. Okay, in February it was 2% and then in June it was 4% respectively. While the lifetime probability of default was measured at 3% and 5% on both the dates. All right, so we have the 12-month probability of default and we have the lifetime probability. This is to calculate loss allowance. So use this information to calculate the loss allowance. It's more like your credit allowance. Credit loss allowance. Eh? Right. It says number 9, it says the impact of the investment in Invest Global Limited's bond has been accounted for in Spree Limited's profits for the year ended 30 June 2023. Oh, that's the one you're answering for the ethical question. Was the matters arising? Okay. Anyways, so it's 8 that we are busy with. So with 8, with what we have read in 8 now, we have to discuss, we have to write an email, draft an email to the group financial director of Spree to discuss the correct classification. So first of all, how should it be classified? Yes, we understand it's a financial instrument. Financial instrument has financial assets, financial liability, and equity instrument. So we have to start there by the classification. We have to start by the classification. And then from there, it's the measurements now. So after you have classified, so we know it's a financial asset, and then how should this financial asset be measured? Remember, there are 3 methods you can use. You can use amortized cost, you can use fair value through profit and loss, you can use fair value through other comprehensive income, all those are the measurement methods. And once you pick up the measurement method, now you have to go deeper into the measurement method and actually measure the item. All right, measure the item, and there are also the initial direct cost. How should it be classified? And then once you have gotten that, remember now they gave us information about what is it called, credit loss allowance. All right, and that only counts when it is amortized. Okay, when an asset is amortized, that's when we use we also calculate the credit loss allowance. All right, so that's basically what you're doing, guys. Find your base. Here is, first of all, pick up that we know that it's a financial instrument, but that is too broad. So we need to specifically classify from the financial instrument, what is it? Then from there, we now begin to go deeper into that one. So we get to dwell deeper into that one. We get to dwell deeper into that one, all right? Remember, every discussion has a base. Right, so let's start. Take it from the top. Okay, so how can you start this, right? Depending on how far you want to go, you can start talking about IFRS 9, financial instruments. So you can even talk about financial instruments. What are financial instruments? What makes a financial instrument, right? From the financial instruments, will I say definition? According to IFRS 9. Okay, we always want to know how we're going to start this, né? Then you come back to this now, all right? So how should this particular investment that we're dealing with be measured? All right. So the fact that we actually purchased this, so you can talk about that part where it talks about we purchasing the bonds. Number 9. Right. On February's pre-limited purchase 500 bonds from Invest What Limited, whatnot. This sentence, you can bring that up here. You can bring that sentence up here, which will then confirm that this must be classified as a financial assets. Now, all these principles and whatnot, you have them. I'm just teaching you strategies of how you can discuss it. All right. So then we bring that up to now say, okay, this should be a financial asset rather. Right. Then you're now in the financial assets. We now begin to say financial asset can be measured in 3 methods. So we now look at the measurements. Right? Measurement number 1, it's fair value. Fair value, right? Fair value through profit and loss. Profit or loss. Or number 2, it can be measured at fair value through other comprehensive income. Number 3, like this one is very, very theory. I know that you, of course, there is a small calculation of the fair value, I mean, the values of the interest and all that, but it's unlike the impairment one that we did. This one that is more theory. Okay. And then it can be measured, number 3, at amortized costs. Right. Now, the first 2, all right, for us to use, for it to be measured at fair value, we need to check the information that we have. Are they giving us fair value at the end of the year? Are they giving us fair value differences? All right. Where is this question? Right here. Okay, there. If you check here, they haven't given us fair value at the end of the year for us to compare with the fair value at the beginning of the year. All right. Of course, there are other principles that you look at, but that's the first thing you're looking at. That's the first thing you're looking at before you actually go to the theory and everything. You want to see that the fair value I had in the beginning, it was 120, but at the end, how much is it? It's not given. All right. So I'm not even going to look at that one as for now. Then I go to test the amortize because this one is making sense. From the information I have, I can calculate PV. Guys, that's the fastest way to know. Can I calculate present value? If I can calculate present value, there's a high chance that I'm going to measure it at amortized cost. But it doesn't work like that, so we can't just say that. We can't just say, no, we measure it at amortized cost because we can calculate present value. No. So we need to talk about the principal itself, right? At what point? So then I go further now to say, so I believe it's measured at amortized cost. Why so? All right. So we go now to principal. Now, according to principal, A financial asset is measured at amortized cost. Okay, so financial assets is measured at amortized cost if there are some conditions that must be done, right? Guys, you see how deep I'm going. I start here, I go deeper into that here. Then financial asset, I go deeper into the measurement. On the measurement, I pick my measurement method and I go deeper into it. Just like that. That's how the discussion is done, basically. Right. So it is amortized if number one, the financial asset is held within a business model. The financial asset is held within a business model whose purpose is to hold, whose purpose is to hold financial assets to collect contractual cash flows. Financial assets to collect contractual cash flows. Right. Then the condition 2 is actually a continuation of the same paragraph, right? Contractual cash flows and, right? The contractual terms, the contractual terms of the financial assets give rise on a specified date. Give rise on a specified date. All right. So they give rise on a specified date to cash flows that are solely so basically only that are only payment of principals and interest. Payments of principals and interest. Okay, and there must not be fair value at the end of the year. You see, that is what I started to check first. If there is fair value at the end of the year, there's a high chance that it's not amortized. Right. Okay, so that's basically it. So then we are going to check. This is what principal says. We have to check this in the scenario. If we're going to just be doing a dump, if you just do a dump, you go and copy principal and put there and move on. It's not going to work like that. So we have to now go and check the information that we have and then put it, link it to the principal that we've just mentioned. All right. So here we say it must be a financial asset is held within a business model whose purpose is to hold, first of all, the purpose is to hold financial asset to collect contractual cash flows. All right. And then the contractual cash flows that they're collecting should have the terms must give rise on a specified date to cash flows that are solely payment of principals and interest. So that's what I'm looking for. So I'm going back to my scenario. All right. I'm going back to my scenario. So there we are. Okay, it says I'm trying to look for information, but let me just read along. All right. 1st February, Spring Limited purchased 9.5 bonds from Invest Limited with a fair value of that and incurred that cost that were directly attributed to the acquisition of the bonds, settled in cash on the same date. The bonds are redeemable at a par value of 100,000 each. So at the end of the day, it's going to be redeemed, right? It's going to be redeemed at this price, okay? And also, where am I? The bonds are redeemable at a par value on these dates, and the interest is paid annually. So there's it, guys. The interest is paid annually. So it's all interest is paid annually in areas on this date, and the coupon rate of 12%. There's a coupon rate of 12%. And then Spree Limited holds the investment in bond with an objective to collect, there's its objective to collect future contractual cash flows of principal and interest at a specified date until maturity date. All right, so from basically from where does it start talking about interest? From here up until here, where it talks about maturity date. You see that sentence there supports what you are saying, but you can put it in proper wording. Eh? I'm just going to do this because of time. It supports this, tells us about the business objective that they have. It also talks about their contractual terms that gives rise to a specified date, and the fact that it's for them to collect solely payments of principal, the coupon rates, right? Coupon rates and the interest. Right, it talks about it there. I've underlined it for you guys. So this, you bring it here, it supports the principal. So then in conclusion, so then we have to conclude now how this should be measured. So in conclusion, the investment in what is this one? Investment in bonds, Invest Global Limited bonds, I'll just say bonds, investment in bonds should be measured at amortized costs. Okay, so that's how it's done. So it shouldn't just be us dumping principal. It is also us bringing principal together with the discussion, the story that we're having in front of us. Then now when we look at the amortized costs, with the amortized cost comes calculation, eh? All right, with amortized costs, so we're gonna have to do with amortized cost, we're gonna have to do amortization table. Guys, this is not part of the discussion. You have to actually do it. I'm just giving you guys tips. So we have to do amortization table where we can actually where we calculate the interest and the PV, right? So we're gonna do that. Then number 2 as well, when an asset is measured at amortized cost, all right? If an asset is measured at amortized cost, we have to recognize loss allowance. All right. So when this one is part of the discussion actually, when an asset is financial assets, when financial asset is measured at amortized cost, all right, we will have to account for the loss allowance. Okay. We have to account for loss allowance on on credit loss. What is that called? Expected credit loss. All right, loss allowance on expected credit loss. Okay, loss allowance on expected credit loss. Okay, that is principal. So if it was measured any other method, it was not going to be necessary for us to do this particular part. But because we are using amortized cost, then we have to also know that amortized cost comes with loss allowance. Okay, so just be aware of that. And you guys may also have the same question in your exam that is coming up. So you need to be very much aware of that. Now, I'll come back to amortization. That one I don't think it's an issue. I just want to talk a little bit about this one. So now we have to go deeper now into this one. So we talk about the loss allowance. All right. Now the loss allowance, they have some condition. All right. So there are some conditions that they will use. For example, if let me just condition number 1. If the asset was not credit impaired, if the assets was not credit impaired, on initial recognition. On initial recognition. All right. We must measure our loss allowance. So if it was not measured, if it was not credit impaired on initial recognition, then what we'll do here, we will measure loss allowance on the 12 months expected credit loss. Ne? We'll use the 12 months. Remember, in the question, they'll give you a lifetime probability and they give you the 12-month probability. So we will use the 12 months probability. All right. Okay. And if the opposite occurs, so if it was the opposite, and also apart from it just being credit impaired, we must also check the risk. Has the credit risk increased? And let me just add, and the credit risk increased, not increased. Credit risk not increased. That's when you use that 12 months. If the opposite, let me just say opposite because I don't want to be repeating this. If the opposite occur, then you're going to measure ads using the lifetime. You measure loss allowance lifetime. Right. Okay, guys, this is me just trying to summarize it and trying to make it short as possible. You have your notes where it explains these things even much detail, right? But the most important thing is to understand what you're doing. So those are the conditions now that comes with loss allowance. So also the loss allowance must also be calculated. So once you have said what you have said, now we have to link this to the scenario. We can't just be talking principle. They're not interested in that. The principle must come together to the scenario. So when you come to the scenario, there is a part that begins to talk about that. And I need to remove this because I can't see anymore. Yes. There is a part that talks about this. It says the bonds were not, there we go. The bonds were not regarded as credit impaired on initial recognition and the credit list has not increased at any stage. You see, this one, it gave us what we are looking for. This. So we can take that information here to support what you are looking for. This is becoming, so that means it's supporting our condition one. Where am I now? Okay. Oh, what did I do? All right. Guys, sorry, ne? I think here technique is giving me issues now. Okay, no, it's fine. There we go. So that information, guys, you will then check that information that talks about the credit risk being impaired, whatnot, and bring it here and then conclude. All right, so we're going to then conclude. Because of that, we are going to measure. We're going to measure our loss allowance using 12 months probability. Okay, and then we're going to do this as follows. I still have to do my amortization, or should I rather go to the amortization because I need the PV. I need my amortization PV, so I might as well do the amortization. Right, what information do we have anyways? Let's start. I'll do the calculation here. To do amortization, I need my interest. Is that given? So let's go back to the information so we can pick up everything we need and do the amortization. It does look like I can use my calculator directly, but let's see. Let's see. My year end is June 30 June 2023. All right. And let's go to our information. Okay, there's a lot of highlights on my information. I'm gonna have to just make sure that things are clean. Sorry, guys. I'm looking for information and I need to make my information clean so that I can get what I'm looking for. Okay. So what do we have? This is our starting point, February 2023, which is during the year. Actually, it's not the same as our financial period. There's pre-limited purchased 9.5 bonds. Okay, this is how much bonds we purchased at a fair value of 120. That's my present value. That's my present value. Also, they have incurred 5,000 transaction costs. So that's my transaction cost. At amortized, we have to capitalize the transaction costs, right? Or initial direct cost, whatever you want to call it. Then we continue. I'm looking for my information so I can calculate my amortization. Costs that were directly attributable to the acquisition of the bonds settled in cash on the same date. The bonds are redeemable at a par value of 100 Rand each on 30 June. Okay, the redemption value is usually the future value. So the redemption value is usually the future value. Right, we're continuing. And the interest is paid annually in areas. Interest are paid on the 31st January. All right, so it's February and January. I could use a direct amortization, and then I'll just break my interest to the parts that I need. Right, it's also possible. It also saves a lot of time. I could just do this amortization from February to January. So that's a full year. And then when I get to June, I'll just break the parts of the June interest for June. All right. So at a coupon rate of 12%, this is where I will calculate my PMT. PMT will get my coupon rate there. Spree Limited holds investment in Invest Global with the objective of collecting blah 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 blah. Okay, so that is all the information that I need that I will use to calculate my what is it called? That I will use to calculate my interests. That's the one I do not have. I can see I do not have interest. They didn't give me interest. They gave me the coupon rate. They gave me the present value, but I'm not given the effective interest. I was about to say IRIL. No, not that one. This is not leases. Anyways, we are talking about the effective interest rate is not given. If they had to give to us, they were gonna give us the market related interest rate without an option. What. That's the one I'm talking about. The effective interest rates. Okay. So with all the information that I have, I can then calculate that. Right, I decided to start with that first before. If I can calculate the loss allowance first, I'll still need my PV and all of that information. PV at the beginning and PV at the end of the year. So we'll then do our calculation somewhere here. All right, I want to calculate all this. We got the figures with us. Calculation 1, I want to calculate effective interest. Right, and PMT, future value, PV, and then we want to compute IY. Okay, so we're gonna have to do a lot of up and down. We did got the figures, but now I have to go and get them again. Okay, so first thing first, what am I looking for? The redemption value is 100. All right, let me start with that one. So my future value is 100 Rand and the shares are 9.5. Right, 100 Rand and the shares are 9.5. 9.5 shares, bonds, sorry, multiply by 100. So that will be my future value. Right, so this will give me 950,000. Right, I'll then use this on my coupon rates, the 950,000 multiplied by the coupon rates interest. I think it was 12 if I'm not mistaken. Okay, where's my question? I think it was 12. All right, yes, it was 12, I'm correct. So it was 12. And then my present value is 120 plus the 5,000. Okay. So we come here, our coupon Coupon interest is 12%. Times 12%, so I'm getting 114,000. Okay, this is paid annually on January, 31st January. Right. And then, so that's what I have. Present value, it's 120. 20 rands times 9.5 bonds. Then plus the 5,000. So I'm getting 1,145,000. 1 million. Guys, are you confirming these figures that I'm putting here? Are you confirming, guys? Are you calculating? Please be calculating along with me. Be calculating along, please. Right, so it starts in February 23 and ends in January 27. So that will be 24, 25, 26, 27. That is 4 years. 4 years. So the period is 4 years. Right, my PV, I'm going to make my PV negative. Right, guys, let's take out your calculator, please. Please clear your calculator. If you're using sharp, it's going to be second function alpha 00. Clear the memory. Also, make sure you're not using the begin mode because they did say the payment is made in areas at the end. Ne? Right, so let's do this together. 4N 114,000. This is my PMT. Then 950,000. This is my future value. Then negative 1,145,000. That's my present value. Then you're going to comp IY. Okay, this is annually, ne? How much are we getting? And I'm very interested in people getting this right. How much are we getting as our interest?
12.13.
12.
I'm
Did you say
getting
12?
12 point. Yes.
No, I'm getting 6. Who else
Oh,
is getting 12?
it means I must divide by 2.
I'm also getting 6.
But why
6.0.
must we divide by 2? What did you do? This is
I don't
annually.
know. Maybe my financial calculator is set at what do you call
So you have to reset it. Now take it back to original.
compound.
Take it to original. Go to the back of the calculator, ne? There's a place where you can put a pen where it says reset. Because you're not supposed to get 12. Who else is getting 12%? The guys that are using HP, did you get the answer correct?
No, I got 12% too.
12%. No, it's not correct. It's either your calculator is set. I don't know how you set the calculator, but we want to set it to be 1 year. This is a year calculation, annual calculation. Check your setting.
Yeah, no, it's correct. 6.07.
Okay, so that's correct. Who else is getting 12? And the rest of us were just quiet. Guys, you are going to write these things on Wednesday, so I'm trying to help you. Eh? Please do the calculation and tell me how much you get.
I got 6.
Exactly 6. You have to remember. You have to set your calculator to
No,
4 decimal
it's
places.
it's on 2 decimal places because it's 6.07.
It must be 4, ne? 4 decimal places. They want 4.
Okay.
Yeah, but you are right. You are right. And then the others, Clive, how much are you getting?
0.0675.
Sorry?
No, I got 6.0675. It's rounded to 4 decimal.
Perfect. Perfect. The rest of us, who has gotten the wrong answer? Please let us know so we can help you. Anybody who got this wrong?
I am getting the wrong answer.
HP, eh?
Yeah.
Check your the settings, the original settings of the calculator. Is it on annual? Like, you know where it says P/L, it must equal 1. I don't know how the HP looks like. I don't even have it with me right now. I'm just trying to help. But you see, the P/Y should be 1.
1,
Now,
right? Yeah, it's 1.
then do the calculation again. And Sam, are you winning, Sam?
Yeah, no, I've given up, honestly.
No, Sam. Check your settings. What does your... There's a place that says pay
Yeah,
here. I don't
it's
know
a
how that
PC
looks
version.
like.
It's a PC version. It's a PC version that I'm using, so it's pointless. I can't reset it.
But you know, you can use Google. They'll go to Google. Put your problem on Google. Tell them the type
Okay,
of calculator you're
okay.
using and how can you calculate.
No, it's the HP. It's the HP.
Yeah, that's what I'm saying. Go to Google, right? So you're gonna write, how do you calculate interest using the type of HP you are using? You know, you have to specify the type. And then you see
All right.
they'll give you steps on how to do that.
All right. Let me be on it. Thank you very much.
All right. Guys, this is very important. They are gonna be calculations like this some way, either in leases or financial instrument or just any other calculation where they just want to bring in a present value. For example, if I buy and I decided I'm going to pay later, that means there's time value of money. I'm going to have to calculate the present value. Or if I sell to somebody on revenue questions, right? If I sell to somebody and that person is paying me later than the normal date, I can charge them interest as well. That means we have to calculate present value. So there's going to be there's definitely going to be a calculation on present value. I can guarantee you, like definite. Okay. Right, guys. It's 12 o'clock. We're going to have our break at 1, eh? So we push until 1. Please bear with me. Until 1. Don't get tired, eh? Then we'll have our break at 1. Right. Okay. Let's continue. So Sam, you tell me how it goes, eh? Take your time and do that. Anybody else who's using HP who has an issue as well, Google is your friend. If you have your manual of the calculator, it's also very good. It also helps. It has steps. I know you guys have bought these calculators a long time ago. You probably throw away the manual. Then use Google for that, okay? But there is a solution, so you're not finished or anything like that. If you still cannot understand it, you can borrow a sharp calculator for the exam on Wednesday.
I got it. I got it.
You got it. Perfect.
Yeah.
It is very important, I'm telling you, because it's definitely there. Somewhere, somehow, you are going to calculate the present value in the exam. Okay? So please, everybody, if HP keeps giving you a problem, please borrow a sharp calculator just for the exam. All right? Alternatively, if you have enough money, you can buy. Although it's not cheap, but yeah. All right. So our interest is 6.0672. Right. It says 4 decimal places. That is my interest. And with interest comes amortization. Right. So from there, I'm able to know how much is my next interest or my next present value. Now, I want us to discuss this. What do you think? Is it necessary for me to do my amortization table in this instance? What do you think? Remember, we keep talking about saving time. Is it necessary for me to do my amortization table?
No,
Okay, why do you say so?
because we only need calculations for 1 year.
Okay, I'll take that. So we need only June 2023, right? And the investment was purchased in February. So basically from February to June is what I need. Okay? But not only this year. Remember, I may also need to use the next year as well. All right? Because let's say I'm doing statement of financial position and I need to know how much is my long-term portion of the investment. So I'll also need next year. All right. So whenever you're working with a year, sorry guys, whenever you're working with a year, like investment within a year, always think about next year as well, because you may need the next year information too. So in that instance, because I only need now and next year, I can just do a calculation on that so that I don't have to waste time doing amortization table. Although I know there is a calculator approach that we usually use. The guys know, they know these things very well. People that are using Sharp, they understand what I'm talking about. We could also do that. We could also use the calculator approach to get my interest, but the problem is the period. It will give me an interest which I'll still need to calculate again because it's not going to be for June. Okay, so either way, you can do this a straight calculation now, or you can use the calculator approach, but remember to apportion back. Up to you. Okay, I'm just going to do a straight calculation where everybody can follow of what we are looking for. All right, so what do I need? I need my interest first. I need interest for this year, and I need my balance at 30 June. All right, so my year ends in June, right? So for me to calculate my interest, I'll use my present value, and my present value date is 1145,000. The interest rate is 6.0672. It's what we're told it has to be 4 decimal places. All right, this is from February. So February, March, April, May, June. February, March, April, May, June. June is at the end, February is at the beginning. Remember that mistake, so we have to be careful there. January beginning, so I can count it. June is at the end, so I can count it. So February, March, April, May, June, 5 months. So 5 divided by 12. Let's calculate. How much are we getting? How much are we getting?
288,192.
288,192. Ah, okay. Let me do this as well. 1. Are we sure about this, guys? You're quiet. Although it looks weird, but sometimes things will look weird. Maybe they are right. So let me just do it.
It's good. It's wrong. It's wrong.
Yeah. So my instinct worked, innit?
Me, I'm getting 28945.6.
Yes, that's correct. Remember, they said the final amount must be
Yeah.
rounded off to nearest rand. So it's 28,946 basically. Okay, who's getting a different answer? But this one shouldn't be a problem. This is a straight calculation. It's not like input and things like that, right? You don't need a sharp calculator. Eh?
It's Kumulimo, so she must be fired because she's giving us wrong things here.
But she's the one giving me answers most. She's been giving me correct answers all along. Okay, guys. Thank you everybody. Can we all confirm? Apart from Sam and I, also getting the figures, or are we struggling? Why are we quiet?
Yes, it's correct.
All right. So I need the interest. Then I need the balance. I need the PVO balance at 30 June 23. Right. So this was what we had. We increased this with our interest. Okay. Then we minus this with the payments, if we did make any payments. Now, the payment they said is only made in January. The year ends in June. So we have not gotten to January. So there have been no payments so far. Are we agreeing? So far, there have been no payments. Therefore, my balance at 30 June is going to be the interest plus the present value we started with. Which is 1,173,946. So when I go to statement of financial position, this will be my balance of the bonds, investment in bonds. All right, that would have been my balance. Okay. Do we all understand what I just did? Anybody who's confused?
No.
Okay, it's straightforward, eh? Right, so now that we have this, when I get to next year now, balance now next year. So balance at 30 June 24, sorry. It's 30 June 24 now. What would happen? All right. So when I get there, I want to calculate further interest. All right, but then it says I must go back. So I'm gonna calculate interest on that period for that period. All right. Remember payment was not made. So from this, we calculated interest in June. So okay. For the year, okay, I'll just do this times 6.0672%. Okay. Yeah. Now the issue with this one, I'm trying to think of what is it? I'm trying to balance this thing with that, but it's fine. My interest is that. That is my interest. Times 0.0672 69469. All right, that's my interest, and then my balance will be as follows. Okay, so we started with 1145. We added the interest last year. We added this year. Then minus the payment. Payment was only made once in January, and the payment is 114. Okay, so my balance is 11294. 1. Okay, let me write this properly. Sorry, guys. Let me write this properly. So it's 1,129,414. Okay, so that is for 2024, and that was for 2023. All right. But I may just need this in the next calculation. Right. Are we good here at this point in time? Any question at this point in time? Any question here? Okay. Then I can then use this information to calculate my loss allowance. All right. So I'm going to calculate my loss allowance at 1 February 23. All right. This is when the event, the commencement date. I also want to calculate it at 30 June 23 by the end of the year. All right. So let's go back to the information that is given to get our loss allowance. Right. So it says the 12-month probability of default was assessed as 2%, and that was in February, and the other one will be assessed at 4%. Okay, we've already from principle determined that we are using the 12 months probability and not the lifetime. Yeah? So we're using the 2% and the 4%. Right. So your calculation of the loss allowance is going to be as follows. And this loss allowance decreases it actually decreases the balance of the loan. All right. Remember, think about credit loss. Yeah? Just think about credit loss allowance. It decreases our debtors, just like the same thing here as well. Okay. So with this, I'll start In February, the PV was 1, or the balance, let me just call it the balance of the investment, was 1,145,000. Yes, 145,000. All right, then we're calculating 2% of this. So that would be my loss allowance on this date. Initially, 1,145,000 times 2%. So I'm getting 22,900. Then by June, remember my balance at June? My balance at June is no longer 114. I've added my interest, so it's 1173945. 1173945. 1173945. All right. That's, then I'll use that to calculate the one at the end. So which is 4%. All right. And therefore, this is going to be 1173945 times 4%. So this is going to be 46,958. Right, we're rounding it off, right? So then we'll get the movement. The movements. So as I go further, first of all, I'm going to count for. Going further is going to be the movement that I'm going to count for, which is the difference between these two. The difference between the two. All right, this and this. That will be the movement. So minus 22,900. So the loss allowance going forward that you'll be calculating would actually be the movement. Right, so I'll calculate this is in this date. Then at 30 June, I'll show the movements. All right, so that is how the loss allowance, guys, is calculated. Basically, so what happens to my PV, right? So what happens to my present value at the end of the day? My present value of the balance, all right? The balance, final balance at 30 June 2023, we're still in 23. So we are putting everything together. I need to say I started with 1145. I add the interest, which was 28,945. 28,945 or 6. Was it 6 or 5? 946. Then I'm going to then minus my loss allowances that I've had so far. All right. So it's going to be minus the first loss allowance was 22,900. Then the second one is the movement, 24,058. So next year when I calculate another one, I'm going to find the movement. So it's not going to be the exact figure, it's going to be the movement. It's just like deferred tax. Think of deferred tax. We use the movements, right? Just like that. So at the end of the day, that will be my balance. Removing the loss allowance on the value that we've already calculated. So 1,145,000 plus 28,946 minus 22,900 minus 24,058. All right, so this is 1,126,988. Right, so that is then your final balance of your investment at 30 June 2023. Okay, so I don't think there's anything else we need to talk about at this point in time. Let me just go back to the question to confirm. And guys, that's what you do. You go back to the question to confirm all the time until you are very sure you've answered the question. Right, because 12 marks is not a joke, ne? Okay, so you're supposed to draft an email. Remember to put it in the format of an email, right? To the Group Financial Director of Spree Limited Group to discuss. So you're discussing the correct classification. We did that. So we classify this as a financial asset, all right? Because we have a contractual right to receive cash, all right? I did say you can talk about the principal, they bring it there, and yeah. And then the measurements. We used amortized costs because of the fact that they use a business model to collect contractual cash flows and interest and so forth, right? We did our homework. We also brought information from the scenario that supports that, so we are good. But we went further. If it is measured at amortized cost, we must also calculate a loss allowance. And we did that. We explained, we linked it to the scenario, and we gave the value at the end of the day. On the 30 June 2023, the measurement value was given. All right, so that one is sorted. We have answered the question in full. Okay, any question? I'm going to B now. Any question on this? Guys, I've given you tips, like since we've been doing discussion questions, I have been giving you guys tips. I hope you are really paying attention to the tips I've been giving so that you guys can master your discussion type of questions. Okay, yeah, so then we go to B now. A has been answered. We are now in B. Right, then comes calculation. I think this is what we enjoy. Most of us enjoy calculations. So B says calculate the consolidated profit for the year attributed to the owners of the parent that will be presented, blah, blah, blah. So we're basically calculating consolidated profit. I don't know if you want to read the whole question because it's consolidated profit that we're calculating, and that's it. Okay. So if it's consolidated profit, it means I'm bringing them all together. And I cannot bring them together if I do not understand my group. All right, what form of investment do I have? What type of group do I have? I need to know that first before I move on. So let's do the group structure. Right, we have Spree at the top. Spree Limited. We have Spree Limited at the top. We need to understand what type of group is this. So we start here. Right. And I think we've done a lot of questions on groups by now. Everybody should be good in groups. Right. It says Zara Limited was founded in 2017 and sells premium kitchen and homeware from brick and mortar stores and an online retail platform targeting the millennial generation. On the 28th February 2021, we are in 30 June. So that's quite a long time ago. Spree Limited acquired a controlling interest in Zahara Limited by purchasing 240 of the issued ordinary shares. The total purchase consideration was 950,950, was settled in cash on the same date. The acquisition of the interest by Spree Limited made the definition of a business combination IFRS 3 business combinations, and on the 28th February 2021, the share price of Zara was listed on market value of 3.70 Rand per share. On 30 June 2020, the retained earnings. Wow. All right. Wow. See this date. This is not this date. Okay. So pay attention to the date, right? They gave us the retained earnings on a different date. And it was a credit balance, which amounted to this. Then they gave us the profit for the 2021 financial period. Right, guys, already you begin to do maths. Maths starts, ne? Maths starts immediately. Okay. And then it says at the date of acquisition, all the identifiable assets and liability of Zara Limited were fairly valued, except for the following. Right. So we have here trade receivables were actually written down. This is the carrying amount. This is this. Then we have contingent liability. And yesterday we had time to speak about contingent liability. I'm just going to repeat it here. Guys, contingent liability name, it is not a liability as per liability definition. Contingent liability happens when there is a possible obligation that we have, and in that possible obligation, the chances of it occurring are low. So because the probability of occurrence is low, we cannot account for that expense or liability, whatever the case is. We cannot. So we only make a note. So in my financial statement, I do not have contingent liability in my financial statement, but I have I do not have contingent liability, but I have provisions. Provision is because there's a high chance that the obligation will occur. All right. So in my books, there's no such thing as contingent liability. It only comes in the notes. But now when it comes to groups, when it comes to business combination, it's a different story. When it comes to business combination, we want the company to also show the contingent liability. Okay. So all of a sudden, it becomes a figure that I have to include. I hope you're understanding me. All of a sudden, it becomes a figure that must be included. But on a normal instance where I'm dealing with my financial statement, I do not include contingent liability. It's just a note that I have to show. All right. So when you see it, we're including it because it's business combination that requires that contingent liability should also be shown. Okay. Then it says, at the date of acquisition, Zara Limited disclosed a contingent liability amounting to 125. Where am I now? Okay, the 125 relating to a lawsuit in its separate financial statement. While the claim represents a present obligation, however, the lawyers of Zara Limited believed the prospect of the outflow of economic benefit was not probable at the time, since there was insufficient evidence to support the claim. All right, so this is the lawyers say they believe that the prospect of the outflow was not probable. Because it's not probable, it's not a provision, it's a contingent liability, right? The fair value of the contingent liability was estimated to be 53,000 at the date of acquisition. The South African Revenue Service will not grant a tax deduction should the claim be successful. The fair value adjustment on all the items above were not accounted for in the separate accounting records. Yeah, I don't know why I'm reading this far, but anyway, we're going to use these informations on the next question more. What I was interested in right now was on the group itself. So we purchased 240 ordinary shares in Zahara. So in Zahara Limited, we purchased 240,000 shares, right? And then the total shares in Zahara was, oh, sorry, I'm looking at question 1 instead. The total shares in Zahara was 400,000 ordinary shares. So 240 are 400,000 shares. Multiply by 100. So 240 divided by 400 times 100. This is 60%. So we actually have 60% shares in Zahara. Right. Therefore, this is a subsidiary. I know I read all the information. We're going to use the information later. I want to jump into the next one. Isabella. What is the relationship with Isabella? So Isabella is a proudly South African company specializing in beauty, personal care products, and fine fragrances sold from its online stores or through its IG ambassadors. Right. On 1 January 2022, Spree Limited acquired 35% of the issued ordinary shares in Isabella. The purchase consideration was settled in cash on the same date. In terms of the contractual agreement with other two operators, Spree Limited exercises joint control over the economic activities of Isabella. The arrangement was appropriately classified as a joint venture in terms of IFRS 11 joint arrangement. Okay, I am going to come back to all this, but for now, I just want to know my group. So it's a joint venture with a 35% interest. So we come here. This information is important for me to be able to start my consolidated profits calculation. All right. So then Isabella. We also have to put the dates. We have to put the dates, is also very important. So this was 28 February 2021. Let me just add this one. This was purchased on 28 February 21. Right? The Isabella one was purchased January 2022. Right. And it's a 35%. It's already been given to us. We don't need to calculate again. And we are also told that this is a joint venture. So we do know that for joint venture comes equity methods, all right? A joint venture is going to apply equity method. Right, and equity methods, the item that will go to profit and loss is share of profit of joint venture. And the one that goes to statement of financial position is investment in joint venture. If we have other comprehensive income, we're also going to have that one, share of other comprehensive income. Right, so now that I have this, I see my group, I see what I have. It means when I'm combining, I'm taking 100% of the parent, 100% of the subsidiary. Joint venture, I only want one line item, which is share of profit of joint venture. All right, so my calculation can then start smoothly, right? So I'm calculating consolidated profit. I'll just write here consolidated profit. They didn't say do a statement of, they just say do the calculation of the value that would actually be represented. So it doesn't have to be in the way you know it exactly. It's just a calculation. I can read the question again for you if you are confused. It says here, calculate the consolidated profit for the year attributed to the owners of the parent. That will be presented. You see, you are doing a calculation that will be presented in the consolidated statement of profit and loss and other comprehensive income. Right? So it's simply a calculation. Okay. So I'll start with the profit for the year. Profit for the year, or net profit, or profit after tax is the same thing. Okay, so we go to our trial balance. There is it profit for the year. We are taking 100% of the parent, 100% profit of the parent. Okay, let me 1, 2, 3, 1, 2, 3. Yeah, here's the figures. 100% profit of the parent, 100% profit of the subsidiary. Joint venture take nothing at all. Okay, so we start. So the parents, it's 1,754,041. 1,754,041. Sorry, guys. Then we go to the subsidiary. The subsidiary one is 1,572,233. We add 1,572,233. I'm just going to add these together. All the adjustments will come here as they come. Okay, so far I'm having 3,326,274. All right, so that is from there. This is consolidated from the both parent and subsidiary. And then we're gonna have share of profit of joint venture. Okay, that one we need to calculate that. And then, of course, we're going to continue as we go. But you can pick up the items that may come here. For example, I will need to reverse dividends. So I know I'm going to have dividends received from Zahara. I'm going to have dividends received from this one, the one that we just did now, Isabella. Okay, so basically that's how it works. Then we go now to read the informations and see, do we have any intergroup transactions that we need to account for? All right, so we are going to check that. Let's go to the question. So this one looks like it's going to be quite a long calculation, but anyways, we have to take it easy. Right. So I'm looking for all the intergroup transactions that occurred at since acquisition, current year, sorry. I'm looking for the current year Intragroup transactions. All right. Equity that affect us in the current year. First thing first, none of the investment was acquired during the year. So my year ends on 30 June 2023. It begins in July 2022. This one was acquired in February 21. So there's 3 periods. So what I'm basically looking for, it's the current year, everything that affects current year. So I can skip here and go to transactions with Zahara. Right, that's where I'm going to start. Transactions with Zahara. It says, where am I? Okay, there we go. Zahara Limited sold inventory to Spree Limited from 1 August 2022, which is the current year. The year starts in July 2022 at a markup of 20% on cost price. The total sales of inventory made by Zahara Limited to Spree Limited during the current year amounted to this. This is the total sales, right? And on 30 June 2023, Spree Limited had inventory on hand amounting to this. That was purchased from Zahara Limited. Guys, I think by now we know a lot about unrealized profit. I think by now nobody can tell us about unrealized profits, ne? We know a lot. We know a lot. All right. Now, the sales for the year. If I had revenue and cost of sales, I was gonna go to revenue and minus the sales for the year, the total sales, which was 732. I was gonna go to revenue minus, go to cost of sales minus, right? But now I'm already dealing with the profits. The effect is 0. If I have to do that now, the effect is 0 because I'm gonna say plus minus, which comes back to 0. So there won't be any points doing any adjustment with the total sales. The adjustment that matters right now, it is the unrealized profit on the closing inventory. All right, that's the one. So we're gonna come here to our calculation of profit and loss. Let me use a different color instead of red. So unrealized profit in closing inventory. Right, so it's going to be like this. I'll take my closing balance. I'll take my closing balance in here, which was 105. So it was 105,875. I'm here. And let me just get every information that I need once, and it's 20% on costs. So 105,875 times 20 over 120. Okay, and of course, this is going to have a tax effect. This profit already includes tax. So I'll just to also show tax here, the tax effect of this. So we get the figure and we also do the tax. Right, so 105,875 times 20 divided by 120. This gives me 17646. This 17646, we multiply this by 27% to get the tax figure. And I'm getting 4941. Okay, please confirm the figures, guys. This is the unrealized profit. This is put in brackets. Okay, I don't know how I ended up writing in black when I was busy with blue. Are we getting the same figures?
Yes.
All right, perfect. So we continue. That was the unrealized profit that we accounted for. I'll repeat, the sales, there's no need to put the total sales because I'm saying plus and I'm saying minus, the same figure. It's going to cancel it out. But if my consolidated statement of profit and loss had revenue and cost of sales, it would have made sense because it was going to decrease revenue, it was going to decrease cost of sales. But the total effect on profit is a nil effect. Right. So we continue.
Now,
Yes.
on the tax, I get 4764.
You get, okay, you're right. I used 28. I think 28 is on my head. Yeah, you're right. I just saw that in my calculator. I used 28. So you said you got how much? 4?
4764.
4764. Okay. Yes, I agree with you. Because in my calculator, I actually put 28% instead of 27. Right. So we're doing good. That's correct. Let's go to the other intragroup transactions. And guys, when you are done with something, you tick it off. So you tick it off like this one is ticked off. Then number 4. On January 2023, which is the current year, Spree Limited sold its machinery to Zahara. Now, the effect of who sold to who is usually affect on the analysis. As for the profit and loss, it's the same. It's the same calculation, whether it's the parent or the subsidiary that is selling it, right? And then here it says on January, so let's read the information. It's another intragroup transaction. January 2023, Spree Limited sold its machinery to Zahara for 69,300. The carrying amount of the machinery correctly calculated amounted to 50,120 on the date of sale. Spree Limited had originally bought this machine from an external supplier on 1 July 2021 for this price. On this date, the machine had an estimated useful life of 5 years, and the residual value of nil was allocated to it. This machinery was classified as property, plant, and equipment under the cost model in the accounting records of both Spree and Zahara. Spree Limited depreciates machinery using straight line method over the estimated useful life. The group's accounting policy to write off depreciation on its new machinery is consistent with the tax allowance granted by the South African Revenue Service. Right. So guys, this is just another one. PPE. Remember, PPE is a depreciable asset. So we must also account for depreciation on it, on the unrealized profits, the tax effect on both as well. Then here they give us the total useful life. So you have to rework to get your remaining useful life, because we have to use remaining useful life to calculate the depreciation. Okay, so just another one. So we are going to have, let me go back to red again. Unrealized profit on sale of, is it machinery? Of machinery, is on sale of machinery. Okay, guys, when we're done with this one, then we go to our break. I can see it's already 1, but let's just finish this question that I'm doing. It doesn't help to leave questions halfway, né? So we'll be done with, when we're done with this one, so when we come back, we'll finish C together. Remember, D, you're doing it on your own, né? Okay, so let's just finish this. Where was I? Right, I'm starting my profit first. So it was sold for 69,300. Okay, then the carrying amount was 50,120 on the date of sale. Ne? So for us to get the profit, we use the selling price and the carrying amount. So it is 69,300 minus 50,120. Okay. So I'm getting 19,120. 180, sorry, 19,180. Please confirm. Right, this will have tax effect.
It's correct.
Right, okay, and then the tax is 1,579. Right, right, once we get this, now it's the depreciation. The depreciation on unrealized profits. So depreciation on the unrealized profit. Right, so I'll take this 19,180, all right, over the remaining useful life. So let's go back to the question now. So when was it was originally purchased in July 2021, and it had 5 years, July 2021. Okay, let's do this on the side. So July 21 up until June 22. right? Then July 22 up until when was this sold? January 23. Okay, up until January 23. So it was initially 5 years. Okay, so that is July, August, September, October, November, December, 6 months. So, okay, so 18 months has passed. Right, total useful life was 5 years. This multiplied by 12. 5 times 12, that is 60 months. So remaining will be 60 minus 18. That will be 42 months. So here over 42. Over 42 months, that will give me a whatnot in months. And then I will then calculate from January up until the end of this year. From January, the time it was sold, up until the end of this year. So that will be January, February, March, April, May, June, 6 months. So I'll get a monthly depreciation times 6. Okay, so I'm getting 2,740. This is added back, né? Added back, and then the tax effect, guys, please confirm the calculation. The tax effect
It's correct.
all right, thank you. This should be 740. This is minus. Okay, so that's how you do it, guys. Everything that you know, but you're just using another way of getting the same answers. Not the usual one that you know. All right. So that is our unrealized profit on sale of machine. Right, so that one, 4 things happened. So we also done with that. We tick it off. Tick it off as also done. Then Isabella, on the other hand, is the joint venture, right? Isabella is the joint venture. I can see there's quite a number of things with Isabella. There's quite a number of things with Isabella. I don't know if I should do the calculation outside or inside. Well, we'll see. Okay, let's rather deal with Isabella on their own because I can see a number of calculations with Isabella. So I'll just put calculations here and I'll call it calculation 1 for Isabella. Right, so first of all, we want to calculate what is their profits. Let's start with profit. All right, it's actually given. Don't know why I'm trying to calculate it. So the profit has been given. Okay, so when I go here, oh, thank God it's this. It's 1,136,902. This has been given. Now let's go and account for all the other informations. Right. Isabella was purchased in January 2022. The year begins in July 22. So it's also 3 periods. All right. So that is fine. It's 3 periods. At acquisition, the returned earnings, I'm just going to read everything. At acquisition, the returned earnings of Isabella amounted to this, and the market value of the shares amounted to that. All identifiable assets and liabilities of Isabella's were valued on the date of acquisition, except machinery, bottling sealing machine with a carrying amount correctly are calculated as that at acquisition. The financial accountant of Isabella was unsure about applying the IFRS 13 measurement. Oh my God, we are here again. We are here with IFRS 13. IFRS 13 value measurement requirements to determine the fair value of the machinery, bottling, sealing machine. Therefore, Right. We might day four. I've lost where I'm reading now. Okay, yes, therefore the fair value adjustment relating to the bottling sealing machine was not accounted for in Isabella's record. Since there are no principal markets, okay, there are no principal markets where a second-hand bottle sealing machine are sold in South Africa. Two markets with different sales price were identified. The Isabella transacts in both markets. If you were in the class yesterday, you know what I'm talking about. But anyways, it's not a problem. Right. Continue. It's not a problem that you should worry about. Okay. And then Isabella transacts in both markets and can access the prices in both markets on the measurement date, January 22. Isabella's financial accountant has provided you with the information related to the two markets and are summarized as follows. So we're given the price, the transport cost, and the transaction cost. Guys, you go with the best price, Nick. You go with the best price, most advantageous markets, which is the one that gives the maximum price to sell or to receive money from the assets. So you use the net price here to compare, but the fair value would not include transaction cost. Okay, first of all, what we are given here, this is the net value. I'm going to use it to compare. So we have Sutherland market and we have Sila specialist market, right? Shop, sorry. This one gives 36, while this gives 34. So we're definitely going with the higher one, and which is this one. So that's the one we go for. The higher net value. But the fair value will not actually include the transaction cost. So the fair value is going to be 42,000 minus 3,000, the transport cost only. Okay. So that one is just for comparison's sake. So 42,000 minus 3,000, this is 39,000. Okay, right. Anyways, so that's the one that we are actually comparing with the carrying amounts, which is this. So that's the one we are comparing with that. Right. And then we continue. The machinery had an original estimated useful life of 4 years and a remaining useful life of 3 years at the date of acquisition. This machine was classified as property, plant, and equipment under the cost model in the accounting records of Isabella. It is the accounting policy of Isabella to recognize depreciation over the estimated useful life of this on a straight line basis. It is the group's accounting policy to write off depreciation on its new machinery consistent with the tax allowance granted by the South African Revenue Services. Okay, so guys, that is the at acquisition situation that will happen, and we'll do that when you do the analysis of owner's equity. That's where we're going to have the revaluation surplus. But the one we are interested in, the one that was going to affect us this year, is the depreciation that comes from this revaluation surplus. All right. It is the depreciation that comes from it because we keep depreciating this until, right? So let's start there. So 39,000 minus 24,000 gives us 15. I'm going to come here. The one I'm interested in is the depreciation because the revaluation surplus is actually accounted for at acquisition. So, but the depreciation continues until this year because it's 3 years remaining, right? So my depreciation is going to be, first of all, we take the 39,000 minus the 24,000. This is the revaluation surplus. This over the remaining useful life. This year is going to be a full year, unless if the remaining useful life has passed. So it's a full year, so it's sorted. Right, so 39,000 minus 24,000 divided by 3, this gives me 5,000. This is actually an expense. It's an expense. Okay. It's not like I am eliminating or anything like that. This is actually an expense. All right, then the tax effect of this expense, tax effect 5,000 times 27% times 27%. This is 1,350. All right, tax is always going to have an opposite direction. Okay, so we have that, we have this. So this one is sorted. Isabella. Right, we're still going to come back anyways because we did it for analysis. Right, but for the depreciation side, I can just do this to say we did the depreciation. Then there's number 7 as well, which is the last one. During the current year, Isabella sold selected fine fragrances and beauty products amounting to these to Spree Limited. Isabella sells inventory to Spree Limited at a profit of 30% on cost price. On 30 June 2023, Spree Limited had inventory valued to 85,000 on which was purchased from Isabella. Spree had that was purchased from Isabella. Now, the sales during the year when it comes to joint ventures and associates, we do not even account for that one because of that principle that says the transaction must affect both statement of profit and loss and statement of financial position. If it's only income and expense, we ignore it. If it's only asset and liability, ignore it. It has to be one income and asset or one expense and liability, something like that. So it must affect both the statement for us to account for it. Yeah? So the sales during the year and the joint venture, we ignore. Then we are interested in the closing balance, so the unrealized profit. But this one, we have to ask the question, who sold, who made a profit? For us to know if it affect the share of profit or if it affect the investment in joint venture. All right, so we need to ask the question, who sold? So if you go back there, during the year, it says Isabella. So it is the joint venture that is selling, right? Isabella sold. So Isabella makes the profit, and therefore, if they make the profit, this must go to share of profit of joint venture, profit and loss. Okay, so it does affect this calculation that we're busy with. So the figure is 85,000 and they sell this as 30%. So I'll go here and say unrealized profit on sale of inventory 85,000 times 30% over 130. 30 over 130. So 85,000 times 30 over 130. This is, I'm getting 19. I'm getting 19,615. Right, this is also going to have a tax effect. Guys, as soon as we're done with the question, then we can go to break, ne? Please. Just be. Okay, so basically that's how it works. So then we have our tax effect like that. I just wanted to go back there. Do we have any other thing? So it was that. Okay, so it was that. That is it. That is the transaction that affects the joint venture. All right, so once we are there now, we get our total profit. And remember, we're only interested in our portion. I think those are all the transactions that affect the profit directly, ne? So we get that, and then we have to apportion it to our 35 that we have. If you want to apportion immediately as you're working, you are also welcome to do that. Or you want to portion at the end, all good. So 1136,902 minus 5,000 plus 1,350 minus 19,615 plus 5,296. So this will give me 11,18933. Right, then we calculate 30% our portion at 35%. Remember the 35% here? That is how much we can only account for because that is our portion. All right. So at 35%, so I'll take that figure and multiply by 35%. And it's giving me 391,627. So as my share of profit, of joint venture. So I'll take this figure 391,627, and then I'll take it to my profit calculation. Share of profit, there it is. All right, so the 391,627. It was calculation 1. That's where I got this, so I don't have to come back going up and down. Then the dividends, right? So let's check out, did they even give dividends? So I'm looking for dividend. There it is. There's my dividends paid. Okay, I'm just making sure. Right. So there it is. Dividend paid by Zahara is 65,520. So I'll come here, 65,520. 65,520, and Zahara, we purchased 60%, so they give us 60%. Then the one for Isabella, is 42,680. 42,680. This will give you 35%. So 65,520 times 60. This is going to be 39312. This we are eliminating. 12,680 times 35. It's going to be 4438. This we are eliminating. All right. Is there anything I'm leaving? So I'm just going to double check. I did my dividends. I did my dividends. I did here. Okay, these ones are just going to be reversed the next period, so we don't have to worry about these. Okay. Done. Done. Okay. Is there something we're leaving out? Okay, everything looks good. Guys, you can also check, is there something we're leaving out? Okay. Right, on my side, everything looks fine. So on day, what we can do now is to total. We total everything to get our profit. And remember, we have to then get the profit portion of the parent. But that one will only be after we have eliminated the NCI. Okay, but anyways, let's just calculate the total for now. So we're going to totalize this. Okay, 3326,274 plus 391,627 minus 39,312 minus 4438 minus 17,646 plus 4764 minus 19,180 and plus 5179 plus where was I? 5179 plus 2740 and minus 740. So I'm getting 3,649,268. Okay, guys. So that is basically the profit that I got at the end. That's the profit I got at the end. So yeah, so that is it. The question is done. But remember, we still have to calculate the portion. We still have to remove the NCI. We still have to remove the NCI portion. We're going to do that calculation later when we come back, because that's the time we're going to do analysis of owner's equity. Okay? Guys, any questions before we go to break? Guys, it's a 1 hour break. Come back after an hour. I want to end this one, then I'll send another link for the other 1 hour. Do you have any questions before we go? Any question, guys? All right, if there is no question, guys, I will see you guys for us to come and finish the last one. The 23 marks question that we're going to do to close for today. We'll do that after break. So come back after an hour and I'll see you guys then. All right. Please enjoy your break. See you after break.
Sharp, sharp.